Think back to the last time something big happened in the markets. Maybe it was a Silicon Valley bank collapse or a tech rally after a string of rough earnings. How did it make you feel? Did you change your investments? Did you think, here we go again, or this is the start of something new? That reflex, where our most recent experience suddenly becomes our entire outlook, that's recency bias sneaking in, and today we're going to break it all down. Hey everybody, and welcome back to From Wall Street to Your Street. I'm Ryan Flanders, your host and your financial coach who traded in his whistle and playbook for a calculator and spreadsheets. Each week, we're talking about the psychology of money, how our brains can get in the way of our goals, and what we can do about it. This week, we're tackling a bias that affects just about everyone, recency bias, the tendency to assume that what just happened will keep happening. Recency bias is when we give extra importance to recent events, even if they're just a blip in the grand scheme of things. In investing, it often shows up as panic selling during a short-term dip or chasing stocks that have just had a big run-up. Our brains like simple shortcuts, and one of the laziest shortcuts is, if it just happened, it must be what happens next. Let's rewind to early 2021. AMC, the movie theater company, was in rough shape. Declining attendance, heavy debt, and COVID shutdowns had crushed its stock price. But then boom, Reddit's Wall Street Bets crowd fueled a massive short squeeze. AMC surged from $2 a share to over $70 a share. It wasn't about fundamentals, it was about momentum and hype. And that's when recency bias took the wheel. People saw what had just happened and assumed it would keep happening. They piled in late, thinking AMC would squeeze again, despite no real business improvement. Many ignored the bigger picture. They were just chasing the feeling of quick gains. I had a younger client, we'll call him Jake, who watched a coworker turn $1,000 into $10,000 trading AMC and GameStop. When we sat down, he was frustrated that his account was only up 8%. Like many investors tend to feel, he thought he was missing out on what was coming next. What Jake didn't realize yet, though, was that he was caught up in recency bias, mistaking a market moment for a new normal. One of the trickiest parts about recency bias is that it's not directional. Unlike loss aversion, where we're reacting to pain, recency bias can happen whether markets are up, down, or moving sideways. And when markets are climbing, we assume they'll just keep climbing. Think about Bitcoin in 2017 and again in 2020. Bitcoin hit new highs and dominated the headlines. People jumped in, not because they had a plan, but because it had just been going up and up and up, and then the crash. Investors who got in late chasing recent gains paid that price. And when markets are falling, we assume they'll keep falling. After 2022's rough market, I had clients who were convinced that every year going forward would be a loser. They wanted to hold more cash, scale back on equities, and just wait it out, even though history shows that rebounds often follow these downturns. And in 2023, that's exactly what happened. But a lot of them had missed it. The bias is the same, only the direction changes. In both cases, people confuse what just happened with what's going to keep happening. That's the danger of recency bias. It clouds our view regardless of what's going on in the market. Now, you might be thinking, wait, isn't this kind of like FOMO or herd mentality? Well, that's a good observation. They're definitely cousins in the behavioral finance family, but they're not identical. Recency bias is internal. It's a cognitive error. It's our own brain saying, this just happened, so it must keep happening. You start expecting recent events to just keep repeating themselves, like a rally that feels permanent or a dip that feels never-ending. FOMO is more emotional than cognitive. It's driven by what others are gaining. It's less about the recent pattern and more about the feeling that you're being left behind. You see your coworker make a killing on, say, Tesla or crypto, and suddenly you feel behind the curve, even if it doesn't fit your strategy. And herd mentality is when we act just because others are. It's the financial version of, if all your friends jumped off a bridge. You might not even know why you're buying a certain stock. You just don't want to be the only one who isn't buying it. So yeah, they all kind of overlap. A lot of people experience all three at the same time, and that's why it's so important to understand these subtle differences. The good news, we'll be diving into FOMO and herd mentality in a future episode. So if this resonates with you, make sure you're subscribed. Here's the thing about recency bias. It doesn't always feel irrational in the moment. In fact, it often feels like the safest, most logical move that you can make. When something just happened, a market rally, a crash, a big news event, It takes up more space in our minds. And our brains are hardwired to weigh recent experiences more heavily than the older ones. It's a leftover survival trait. The most recent danger was probably still the most relevant, but what works in the wild doesn't always work in the market. That emotional intensity, the fear or excitement that comes from recent news, can push logic to the background. Even when we know better, it feels like we're just being realistic, but in many cases, we're just being reactive. This is why long-term investors often feel like they're going against the grain, because they are. They're choosing patience over panic and discipline over impulse. Now, let's connect this to your everyday investing behavior. Think about the financial headlines you see most often. Are they calm, balanced summaries of long-term data? Of course not. They're reactive by design. Phrases like stocks plunge, market meltdown, or rally roars back grabs your attention and keeps your brain in a state of alert. And when you're in that state long enough, you begin to internalize the message. This is the new normal. And that's when recency bias becomes dangerous, not because you're emotional, but because you've mistaken short-term noise for long-term signals. Here's a simple tip I give to clients. Whenever you feel that urge to act immediately based on something you just saw or heard, stop and ask yourself, would I be doing this if I hadn't just read that headline today? If the answer is no, you're probably being fooled by recency bias. So, how do we protect ourselves from this bias? 1. Zoom out. A week, a month, even a year, they don't define your financial future. Long-term thinking wins. 2. Stick to the plan. When you have a written investment strategy, it gives you confidence when the headlines begin to scream. 3. Use data, not emotion. Recent doesn't mean reliable. Your gut isn't always your guide. 4. Get coached. Just like athletes need someone to spot them, investors need someone to say, hey, step back. Let's look at the bigger picture here. Recency bias is subtle. It tricks you into thinking a moment is a pattern. But investing isn't about what just happened. It's about what's possible over time. So next time you're tempted by the newest hot stock or rattled by a rough week in the market, ask yourself, am I reacting to today's news? Or am I following my long-term plan? Next week, we're shifting gears into overconfidence bias, the voice that's in your head that says, I've got this all figured out. Spoiler, it's not always right. You don't want to miss it. Until next time, stay steady, stay focused, and remember, Wall Street might move fast, but your plan should move with purpose. Securities and advisory services offered through Commonwealth Financial Network. Member FINRA SIPC, a registered investment advisor. Fixed insurance products and services are separate from and not offered through Commonwealth. The Flanders Group is located at 221 Maitland Street, Bel Air, Maryland 21014. Phone number 410-569-4506. Investments are subject to risk, including the loss of principal. Some investments are not suitable for all investors, and there is no guarantee that any investing goal will be met. Past performance is no guarantee of future results. Talk to your financial advisor before making any investing decisions. The client example presented in this podcast is for illustrative purposes only and should not be construed as a recommendation. It may not be representative of your experience.
1